John Williams, just the latest Fed speaker to tell us there's going to be more hikes, but that they believe there's going to be a soft landing. Last week it was Austin Goolsbee. Do you believe that's actually possible? Can we get 2 more hikes and still see a soft landing in the U.S. economy?
Well, Frank, it's all about this juxtaposition that we have today. On one hand, you've got monetary policy, which is incredibly hawkish. On the other hand, you have fiscal policy, which is incredibly supportive to the economy. Think about many, many measures that have been announced thus far, be it Inflation Reduction Act, be it national security measures, be it rewiring of global supply chains, infrastructure spend. So trillions of dollars that are being infused into the markets, creating jobs, etc., which is one of the major reasons why, despite very sharp rate hikes, the economy is holding up quite well.
Yeah, so it sounds like you're saying the Fed sees it sometimes the way investors see it. Good news is actually bad news. When we see wage increases, we see, stimulus being put into the U.S. economy. That's actually bad news, at least when it comes to inflation. Long term, how does that cycle play out? Because as you mentioned, people have more money to spend, so prices remain elevated because people can spend.
That's exactly it. And that's why, looking at the inflation figures, it's all about core inflation. And core inflation is around the 5 percentage points mark. That's nowhere near the target of 2%. Services inflation is sticky. And the issue is all central banks in the world were too late to start the rate hike cycle. They were all talking about transitory for too long. And the risk, what happens then is services inflation, especially, inflation gets embedded into the sector. It gets sticky. And as long as people have their jobs, as long as wages are growing, people are very happy to continue consuming services, which is what's happening right now.
Right. So we see people still consuming, but one thing that some people at least are pulling back on is stocks. A lot more people are getting a little bit pickier when it comes to stocks, especially here in the second half of the year. I know you have an investor's manifesto. I want to hit on 2 points of it. One point on it is market share, and the other one is ROIC, return on invested capital. Give us a sense of how important that strategy is when it comes to picking stocks right now and the metrics that you're looking at.
Yeah, so just quick recap. Our investment manifesto is incredibly simple. It is, we look for companies that have a very strong competitive positioning, a strong USP, a very strong focus, and correct alignment with us as shareholders. Now, the first one, competitive positioning, is extremely important right now. And you've referred to 2 things. One is market share. One is return on capital employed. Let's start with return on capital employed. For every company, for every decision maker at companies, leaders at companies, they make decisions on how they are going to invest every incremental dollar of capital in their business. It might be in a factory, it might be in hiring new people, it might be in customer acquisition for, digital marketing, for example. Now, every incremental dollar that's invested is invested based on an expected return. And that's captured by the return on capital invested. We've come from a world, a decade, where rates were so low that, it's all about the spread. What is my cost of capital compared to what is the return I expect to generate on my capital? If my cost of capital is almost zero, it doesn't really matter what my expected return is,
right,
because my spread is there and I'm happy.